We still have Bill Lee, who, of course, is now an important economist that we are talking to, along with John Silvia, who's the chief economist for Wells Fargo, and then CFRA Chief Investment Strategist Sam Stovall. And we also have Teddy. Okay. Let me first get to Sam Stovall. You just heard Charlie Gasparino say that if that 10-year yield falls below 2%, equities start to maybe sell off. Are equities in a danger zone right now, or at least investors who are heavily invested thinking, well, this is the best place to be?
Well, I think I'll take your second part of the question first. And when we're 8 years into an economic expansion, 8 years into a bull market that's the second most expensive since World War II, you definitely should not be chasing equities at this point and going too far out on the risk curve. That said, however, since 1953, whenever the dividend yield on the S&P 500 exceeded the yield on the 10-year note, the market was up 80% of the time 12 months later and was higher by 18%. It was even in double-digit territory when the 10-year note was higher than the yield on the 500, but by less than 1 percentage point. So with low interest rates and the low inflation environment that we're seeing today, history actually says the opposite, that stocks tend to do well.
Okay, so I can interpret that you say pretty much stay well invested, but has anything changed in the wake of what happened 2 hours ago, or 2 p.m. Eastern, that the Fed has hiked rates 1/4 of a point? When it comes to your guidance, Sam, where you say go into this and get out of this, has any of that changed?
No, it is not. I like to say that a boxer is rarely felled by the punch he expects. And the Fed has been telling us to expect higher rates for the last 2 years, and they're trying to do the exact same thing now, unwinding their balance sheet. They're letting us know well in advance what they're going to do, at what pace, and for how long. Okay,
John Silvia, you're over at Wells Fargo. You're sitting on the trading floor. Is that where economists get to sit?
Yes.
And you see that Janet Yellen says, I don't see growth by the end of 2019 any better than under 2%. You say, yes, she's right, or the president's right. We'll be at 3%.
Well, our estimate's more like 2.5% growth. But going back to your earlier conversation with Dennis, I mean, clearly you need better productivity and better labor force growth to get the economy moving going forward. And sitting with the bond traders today, the low CPI number that came in this morning, I think it reinforces the point that, at least on the domestic side, the inflation numbers stay pretty low for a longer period of time.
Dennis is still with us. Dennis, what say you about that?
Exactly. Well, I think John and I are on the same page with this. He mentioned population growth and labor force growth. That's also part of the equation, that we have declining participation. The decline actually resumed in the last report. Before I left the Fed, my staff did a survey of different possible scenarios for labor force participation, and in almost every scenario they came up with, they saw the labor force growth rate continuing to decline. And therefore, we just have a lot of, I think, what you might call secular or even structural elements that are weighing on the ability of the economy to grow at 3% or greater on a sustained basis.
Yeah. You know, look, Teddy, I know you're on the floor of the New York Stock Exchange. The odds for a September hike were at 28% this morning. Now they're at 18%, a fall of course, 10%. Do you run out and start signing up for a mortgage? I mean, if somebody's sitting there thinking, I want to buy a home or an apartment, is now the time?
Well, I mean, I think everybody has been concerned that actually have been looking at mortgage money, that, you know, with the Fed threatening to raise rates, which they've done, you know, that we'd see a bounce in mortgage rates. But the fact is, the rates have remained relatively flat, and in fact, perhaps have trended down a little bit. So, I mean, money's still cheap. The housing market's doing pretty good, and I think a lot of that clearly has to do with the cost of money. And as long as money stays cheap, I think, you know, now's the time. You can't pick the bottoms, Liz, you know that, just like stocks. You know, trying to pick bottoms and tops is a huge mistake. I think the trend is higher for rates. Is it going to take longer than folks think? Perhaps. But I think now's the time. And if I were locking in mortgage money, I'd be doing it now.
Hey, Charlie, look at this. The Dow's now up 52. We're blowing out ceiling after ceiling. And again, the Fed either could be cheered for having improved people's 401ks and pensions and 529s and portfolios, or they will be eviscerated later for having created some type of bubble with such low rates.